Okay, so the question is, how do you make money in the markets with incredible inflation and rising interest rates? That is the question that every sentient being is asking today, and I'm going to answer it in this video. Okay, so ever since the Fed announced that it was changing its policy and essentially taking away the punch bowl, raising interest rates, reducing liquidity, the market has been crashing. The high beta stocks and the high valuation stocks, largely tech stocks in the NASDAQ, have been crashing, and everyone's been deciding what to do and what sector should they rotate into to protect and grow their money. Okay, so it's clear that we're in a very confusing time period right now where we have extremely high inflation, and we also at the same time have a change in Fed policy. So for those of us who are trying to decide what to do with our money, how to play the market, and how to actually make money, it's a very confusing time period. So I have a couple thoughts on how to deal with this current situation. If you think interest rates are going to continue to rise and we're going to be in a period of prolonged inflation, this is what you should do. My first suggestion is turn to dividend stocks. The great thing about dividend stocks is they are not as volatile as high growth stocks, and you get paid to wait for the stocks to go up. As a result, they are more stable and they can offset some of the volatility you see in the rest of your portfolio. I have some stocks here to recommend. Very simple recommendations. Some of you will not be surprised if you see my past videos, but here they are. First of all, the Mac Daddy of oil and gas companies, Exxon Mobil. And with oil and gas prices continuing to go up, and I think oil is going to blow past 100 in relatively short order, you can expect this company to continue to grow its cash flow and also grow its dividends. Ditto for Chevron, same situation. Its current dividend is 4.18%, a little bit lower, but an equally good choice for a dividend stock. Next up, we have Verizon. Now, I've been recommending this for a while on this channel. It currently pays a 4.8% dividend. It has an enormous franchise in the telecommunications business. It will continue to grow and continue to pay and grow its dividend. Next up, we have Philip Morris International. Now, this is the international division of the old Philip Morris. When it was split into three groups, or three companies, it was split into Kraft, Philip Morris International, and Altria, which is the domestic tobacco company. Philip Morris International currently pays a dividend of 4.83%, and while it's not a growth stock, it is going to grow over time as people are still, unfortunately for them, still smoking cigarettes. And last is the domestic residual of Philip Morris, which is called Altria, and that one is paying an astounding 7.17%. Not seen as a grower, but it pays a reliable dividend. And all of these stocks I recommend, if you have them either in a retirement account or even in a regular account, please invest them in a DRIP program, which is the dividend reinvestment program, so that every time you get these large dividends, each quarter you buy more stock and the return compounds on itself. Great idea for long-term investing. Second area I recommend, large cap tech stocks, okay, but not all of them. And the reason I recommend these is because these companies, these larger companies, are near monopolies, and they have a moat around them. They have a guaranteed cash flow. They are have reliable growth rates, and as long-term holds, they are phenomenal investments. Okay, and the great thing about them is they will continue to grow because they are monopolies or near monopolies in good or bad markets, in fast-growing economies or slow-growing economies, okay? So some of these names are, kind of obvious, but I just want to name them all here. The first one is Apple, okay? Apple, phenomenal company, enormous franchise value, incredible customer loyalty, tremendous innovation, everything you would want to see in a tech giant, and I think they will continue to be a real winner over the long term. The next one is Google or Alphabet, whichever you prefer. This company is just a monster, completely dominant in its field. Some think it's a complete monopoly, and in many cases it is. It's become a household word. You Google things. I mean, I don't need to tell you what Google is. Everybody uses Google. Absolutely fantastic company and fantastic long-term investment. Even though it jumped up a little bit recently, it sold off during the so-called tech wreck, and now would be a great time to get into it. Buy the A shares so you have the voting rights, and you should do very well long-term with Google. The other one I really like is Amazon. I mean, again, this is something that everybody uses. Amazon is a monstrous company. They infiltrate so many areas of our lives, and this company will continue to grow and is a great long-term investment. The last one I wanted to mention is Microsoft. I've been following this company for a very long time, and this company is one of the tech giants, also a virtual monopoly when it comes to the operating systems. They are monstrous in the cloud, which is a massively growing business, as is Amazon. And, this company as a long-term hold, I think will continue to grow at a fairly steady pace. It pays a very small dividend, which is insignificant. But these four companies, tremendous going forward, regardless of what the economy does, regardless of what Fed policy does, they will be, in terms of the long term, fantastic investments. Now, if you can't decide on these different companies, you can either buy the 𝐥𝐤𝐞 that I've talked about a lot, which is the ETF that tracks the NASDAQ, and also you could look at the 𝐡QQQ, which I've recommended on this channel, which is the triple leveraged 𝐥𝐤𝐞, which goes up 3 points for every 1 point in the 𝐥𝐤𝐞. You may notice that I left out Netflix and Facebook. I think that those two companies have severe problems, and I will touch on them in future videos. Next up is bank or financial stocks. Okay, now in a period of rising interest rates, bank stocks should perform well because banks make a lot of their money based on the spread between what they lend out and what they make. So as interest rates go up, the spread widens and they make more money. Okay, pretty simple. I'm not a big fan of bank stocks in general, but there is one company that I absolutely love, which I think is the gold standard of all bank stocks, and that is JP Morgan. I worked at JP Morgan. I believe JP Morgan is the greatest banking franchise ever devised by human beings, and it is really a wonder to behold, not only looking at it from the outside, but also when you're inside working at the company. Unfortunately, all banks were basically taken over by the government after the financial crisis. So while I think it is a phenomenal company and a phenomenal franchise, working there was a little constricting because the company is basically working at the behest of the federal government. The next company is Berkshire Hathaway, the holding company owned by Warren Buffett. I won't talk a lot about that, but I have it categorized under financial because they are a very large owner and operator of insurance companies, both insurance and reinsurance, but they own, a tremendous array of manufacturing, energy, railroads, everything. You're not going to hit a home run with this thing because it's just too large to grow fast, but you're certainly not going to lose money, and it's a very safe place to park money, and I love having my money managed by Warren Buffett and or his successors. And the last strategy I wanted to talk about is commodities. Some of the smartest people on the planet, like Paul Tudor Jones and others, have started to talk about a commodity supercycle with the incredibly high inflation and all of the problems that we're having with the supply chain, etc. Some people think that we're going into a commodity supercycle. And what is a commodity supercycle? Okay, basically what that is if you take a look, commodity price supercycle are extended periods during which commodity prices are well above or below their long-run trend. They're expected to last much longer than business cycles, which in Canada and the United States have lasted 6 years on average in the post-war period. Indeed, these supercycles are generally thought to take decades to complete a trough-to-trough movement. I guess the area where I am the most bullish right now, and I have been for the last year and a half if you've been watching this channel, is I am tremendously bullish on oil and gas. We've been in on this channel, we've been in Exxon, Mobil, and Chevron going back to October of 2020. Very long time. I've made a tremendous amount of money on this, and I hope that you have too if you've been watching this channel. I think that oil and gas is a very valued commodity where we see a supply-demand imbalance. That's going to continue. So if I were you, I would have exposure to the energy business, and specifically, I recommend that the way you play it is the integrated oil companies like Exxon or Chevron. Now, there is another trend afoot that I think warrants a very close look, and this is the whole green energy thing, all right? And what commodities are going to be in high demand and currently in very low supply going forward to make batteries which will support a growing EV market, and also to support battery production and battery innovation to support other green energies like hydro, wind, and solar. Now basically the ones that I focus on are lithium, right? That is needed for modern battery production, cobalt, and nickel. There are several different ways to get exposure to this. One is to invest directly in the mining companies that mine these metals. And another way, of course, is to go into the ETFs. Here you see a couple suggestions. One is Albemarle, or Albemarle. I'm not exactly sure how you pronounce that, but it is the world's largest supplier of lithium. You can go into that directly. It's got a $32 billion market cap. Its symbol is ALB. Another one I would recommend here is Livent. Livent was spun off from another company in 2019 to create a pure lithium play, and that is something to look into. The symbol is LTHM. Another way of playing this is to go into an ETF which encompasses all of the metals that are mined to support green energy and the evolution of battery technology. And the one that I recommend taking a look at is Global X Funds, and the symbol is LIT. Of course, there are other metals and precious metals to take a look at that can be seen as a hedge against inflation, and also can be valuable in the future with supply-demand imbalances. One would be copper, the other would be gold, silver, platinum, and yes, diamonds. Okay, now one more thing I want to say is there are different ways of looking at this. One might think that with the Fed changing its position and taking the punch bowl away, raising interest rates, draining out liquidity from the system, all of this might cause the economy to slow down at some point. If that happens, you know, we could possibly go into a recession, okay? And in that case, inflation would come down. Now, a lot of people think that this could happen. I'm not saying they're wrong. I could go either way on this. But for the time being, if you're looking for ways to protect yourself and or make money during a period of high inflation and a period where interest rates are expected to go up, the suggestions that I made on this video is something for you to take a look at. Okay, so those are my thoughts for the current period. If you got value out of this, please subscribe, like, and hit the bell so you can be on board for future videos. And I want to thank you for joining. And for now, it's Greg out.